Banks are supposed to be the most secular institutions on earth: spreadsheets, interest rates, regulators. So here's the contradiction. The entire concept of banking was invented inside religious buildings, by priests, for gods. The most modern financial system on the planet was born in the most ancient sacred one. That's not a coincidence. It's a clue about what trust actually requires. And it's the same clue hiding inside every bank you've ever used. Picture an entire city where every single person keeps their wealth buried in their own backyard. No banks, no shared vaults, just silver and grain, hidden under dirt, guarded by nobody but the owner. At first, that sounds safe, but it creates a bigger problem. Buried wealth can't build anything. It can't fund a trade caravan, expand a farm, or grow a business. It just sits there, doing nothing, while the whole city stays smaller and poorer than it could be. This is the problem every growing civilization eventually runs into. Wealth only becomes useful when it moves, when it gets stored somewhere safe and then loaned out to people who can put it to work. But moving wealth means trusting someone. And trusting a stranger with your life savings, with no relationship and no guarantee, is not a small ask. This is not just an ancient problem. It's the same wall modern economies hit every day. Every time someone deposits a paycheck, sends money through an app, or takes out a loan, they're relying on total strangers to hold their money honestly. The challenge has never been having wealth. It's been convincing people that handing it to someone else is actually safe. Around 4,000 years ago, in ancient Mesopotamia, people found an answer to this problem. And it wasn't a bank. It was a temple. Temples sat at the center of every major city, and they weren't just religious buildings. They were considered the safest place in the entire community. The reasoning was simple. These were sacred spaces, watched over by gods. Stealing from a temple wasn't just a crime against a person, it was a crime against a deity. That belief alone did something remarkable. It turned religious fear into a security system. So people began bringing their grain, their silver, and their valuables to the temple for safekeeping. Priests recorded every deposit, keeping careful records on clay tablets using cuneiform writing. This wasn't casual bookkeeping. It was a structured system of accountability, where every transaction left a permanent, traceable record. But priests didn't stop at storage. They noticed something practical. All this deposited wealth was sitting there, and used, while farmers and merchants outside the temple walls desperately needed resources to plant crops or fund trade. So the temples began lending. Grain and silver that once sat idle in storage started flowing back out into the economy as loans, expected to be repaid with interest after a harvest or a successful trade. This wasn't an informal favor system either. By the time of Hammurabi, in the 18th century BCE, these lending practices were formalized into law. The Code of Hammurabi laid out rules for interest rates and debt repayment, giving structure and consequences to what had started as temple-based trust. So look at what actually happened here. 3 separate forces were stacked on top of each other. First, religious fear discouraged theft. Second, written record-keeping created accountability. Third, legal codes enforced repayment. None of these forces alone would have been enough. Fear of the gods doesn't stop someone from lying about how much they deposited. Record-keeping doesn't stop someone from denying a debt exists. Law without trust in the institution holding the records doesn't work either. It was the combination of all three that made temples function as the world's first trust machines. People weren't just trusting a building. They were trusting an entire system designed to make betrayal costly and repayment expected. For roughly 2,000 years, this system worked. But eventually, something changed. Religious authority stopped being enough to guarantee that a stranger's wealth was safe. Societies needed a new kind of trust, one that didn't depend on shared belief in the same gods. As societies grew larger and more diverse, religious authority alone couldn't hold an entire financial system together anymore. Strangers doing business no longer shared the same gods, the same city, or even the same country. So the mechanism of trust had to change. What replaced it wasn't a new belief system. It was a new kind of institution built on documentation, law, and eventually, government backing. The record-keeping side of temple banking evolved into formal accounting practices. Ledgers became more precise. Bookkeeping systems were standardized. And banks, operating as chartered institutions, took over the role temples once held, accepting deposits, tracking them meticulously, and lending out a portion of what they held to businesses and individuals. The lending function stayed remarkably similar to the ancient model too. Just like temples once lent out stored grain and silver, modern banks practice something called fractional reserve banking. They keep only a portion of deposited funds on hand and lend out the rest, earning interest and putting idle money to productive use in the economy. The mechanism is nearly identical. Only the materials changed. Grain and silver became paper currency and digital numbers. But the piece that really replaced religious deterrence was something else entirely: government-backed guarantees. In the United States, this became especially clear after a wave of bank failures during the Great Depression, when panicked customers rushed to withdraw their money all at once, causing banks to collapse. In response, the government created deposit insurance, most notably through the Federal Deposit Insurance Corporation. This system guarantees that even if a bank fails, depositors' money, up to a certain limit, is protected. Think about what that actually does. It performs the same psychological function that sacred temple walls once did. A Babylonian farmer trusted his grain to a temple because he believed the gods would punish anyone who stole it. A modern depositor trusts a bank because they believe the government will make them whole even if the bank collapses. Neither guarantee is really about the physical building. It's about an external authority backing the promise. Central banks and financial regulators serve a similar structural role too. They monitor banks, enforce rules, and act as a stabilizing authority over the entire system. Much like how ancient legal codes, backed by kings and priesthoods, gave structure to temple lending. So the underlying architecture hasn't changed nearly as much as it looks on the surface. Modern banking replaced divine authority with legal and governmental authority. It replaced clay tablets with digital ledgers. But the basic components, a trusted third party, transparent records, a credible deterrent against betrayal, and a system for putting stored wealth to productive use, are still all there, just wearing modern clothing. Strip away the religious language and the government paperwork, and both systems are built from the same four basic parts. First, a neutral third party holds the wealth instead of the owner. Second, a record-keeping system tracks exactly what belongs to whom. Third, some credible deterrent discourages the institution from betraying that trust. And fourth, a mechanism exists to take wealth that would otherwise sit idle and put it to productive use through lending. Temples had all four. So do banks. The materials changed. The authority backing the system changed. But the underlying architecture is the same blueprint, built twice, for 1,000 years apart. Once you see that framework, the similarities are hard to miss. Priests recording deposits on clay tablets function the same way bank clerks and auditors do today, creating a permanent trail of who owns what. Temple lending, where stored grain was loaned out expecting repayment with interest, works on the same logic as fractional reserve banking, where deposited money is loaned out rather than left untouched. Fear of divine punishment for theft mirrors fear of legal punishment for fraud or embezzlement today. And a temple's reputation within its city, which determined how much people trusted it, functions similarly to a bank's credit rating or public reputation in a modern market. In both cases, trust isn't really placed in a building. It's placed in a system that makes betrayal costly and repayment likely. But forcing this comparison too far would be inaccurate, because there are real differences that matter. Temple trust was local and communal. It depended on a shared belief in a specific city's god, in a community where reputation could spread quickly because everyone was closely connected. Modern banking trust is systemic and abstract. It depends on national laws, distant regulators, and institutions most depositors will never interact with directly. Nobody personally knows the regulators enforcing FDIC rules, the same way a Babylonian farmer might have known the priests running his local temple. There's another key difference too. Ancient temples merged religious, economic, and sometimes political authority into a single institution. The same priests managing deposits were also religious leaders within the community. Modern systems deliberately separate these roles. Religion, government, and banking operate as distinct institutions, specifically because concentrating that much authority in one place creates risk. And the type of punishment backing each system is fundamentally different. Ancient deterrence relied on spiritual consequences, a fear of divine punishment that required shared religious belief to work. Modern deterrence relies on legal and regulatory consequences, backed by the enforceable power of the state, regardless of what anyone believes. So the comparison isn't a perfect mirror. It's closer to the same underlying skeleton, wrapped in very different skin depending on the era. This is where the real pattern emerges. It's not really about temples, and it's not really about banks. It's about what happens anytime a society needs strangers to cooperate at a large scale. Whenever that need arises, some version of this same structure tends to appear. A trusted third party holds resources. A credible deterrent discourages betrayal. And transparent record-keeping makes accountability possible. This shows up far beyond banking too. Courts function this way, holding society's trust in fair judgment, backed by law and precedent. Credit bureaus function this way, tracking financial reputation across thousands of institutions. Even newer inventions like escrow services and blockchain-based systems are attempts at solving the exact same ancient problem, just with cryptography and code standing in for gods and government. Which points to something worth noticing about trust itself. Trust at scale has never happened naturally. It has always been engineered. Every era invents its own version of a credible deterrent, whether that's a god, a government, or a piece of code, and builds its record-keeping systems around it. The technology keeps changing generation after generation. But the underlying structure required to get strangers to cooperate with their wealth has stayed remarkably consistent since the very first temple ledger was written on a clay tablet in Mesopotamia. Trust has always been engineered, never assumed. Priests used gods, modern banks use governments, and today's platforms are experimenting with code instead of either one. So here's the question worth sitting with. As trust keeps getting rebuilt with new tools, blockchain, AI, decentralized platforms, what do you think will end up playing the role the gods once played? Drop your answer below. I'll read through the most interesting ones.